Analysis of financial statements is done in a lot of different ways. One of such ways is to do ratio analysis. But first, let's talk about financial statements. So, basically, financial statements include your statement of profit and loss and balance sheet. Overall, there are different ways to analyze your financial statements, like comparative statements, common size statements, cash flow statement, and one of the most favorite of analysis is ratio analysis. So we are talking about ratio analysis today. So ratio analysis is done like analyzing different types of ratios. So there are profitability ratio, there is liquidity ratio, there are solvency ratios, activity ratio, etc, etc. So let's go one by one and let's discuss all these ratios that we have under ratio analysis for your financial statement. So the first one that we have is profitability ratio. That is under profitability ratio we have three types of ratio, basically: gross profit ratio, operating profit ratio, and net profit ratio. You must be aware of all these ratios. So if you're talking about gross profit ratio, it is just simple comparison between your trading profit and net sales. This is just a percentage, what percentage you are earning upon your sales, that is your direct profit. So what we do is net sales is basically your gross sales minus any sort of returns that you have. And to find out the gross profit, we reduce cost of goods sold from your net sales. So we get gross profit, and cost of goods sold is nothing but your adjustment, your purchases plus any sort of direct expenses that you incur into production, and adjustment for opening and closing stock. So here we have a simplified formula where we have opening stock plus purchases plus direct expenses minus closing stock, and we get cost of goods sold, which is to be reduced from net sales in order to get your gross profit. And then gross profit is divided by net sales multiplied with 100, so you get a percentage. For example, your gross profit is, let's suppose, 2000 and net sales is, let's suppose, 10,000. So you will be having gross profit ratio is equal to 2000 divided by 10,000 into 100, so you will get a figure of 20%. So you can conclude that we have a gross profit ratio of 20%. Similarly, this operating profit ratio, this is a little bit advanced version of gross profit, where you also reduce operating expenses from your gross profit. Operating expenses are nothing but the expenses that you have to incur anyway if you are running the business, like your electricity, rent, etc, etc. So your gross profit was 2000. Let's suppose you have operating expenses of rupees 500. Now you will have operating profit of 2000 minus 500, that is 1500, and your net sales are same as 10,000. So if you are calculating operating profit ratio, where operating profit divided by net sales is equal to 1500 divided by 10,000, so you will get a operating profit ratio of 15%. Simple. And next one, this is a little bit more advanced and more accurate version, where you get the net profit. Here we are reducing all the expenses that we have from our gross profit, or rather you can say from net sales, if we also reduce cost of goods sold, because under gross profit we have already reduced the cost of goods sold. So we get a gross profit ratio, and we reduce operating expenses minus all other expenses that we have. So every expense is reduced and we arrive at net profit. So let's suppose your total expenditure after gross profit is, let's suppose, 1000. So you will reduce all these expenses from your gross profit, that is, let's suppose, 2000 minus 1000. You will get a net profit figure of 1000, and your net sales is already 10,000. So if we are calculating net profit ratio, then we will divide net profit by net sales and multiply it with by 100. So 1000 divided by 10,000 into 100, which gives a figure of 10%. So this is like you originally had 20% gross profit ratio and 15% of operating profit ratio, and the final one, net profit ratio, is nothing more than 10%. So here you have an actual analysis that your gross profit is 20%, operating expenditures are your 5%, which makes your operating profit to be 15%, and the actual net profit that you have for distribution or appropriation is like 10% only of your net sales. So it gives a clear cut idea, it shows your profitability index. This is how you get an idea how profitability ratios work. And the next one is liquidity ratio. Liquidity is very simple. You're just trying to analyze how liquid cash you have, not liquid cash actually, but liquid funds to pay your immediate liabilities. So here we have two types of ratios, basically current ratio and quick ratio. Current ratio is nothing but a comparison of current assets and current liabilities. So you get proposition, what we call it, not proposition but just a ratio, just a comparison between current assets and current liabilities, what proportion it is, what proportion your current liabilities are as compared to current assets. So what we do is divide current assets by current liabilities, and under current assets you include your trade receivables. Trade receivables include your bills receivable plus debtors, any sort of receivables that you have with respect to your trades or credit sales. And then there is inventory. You include your cash and any sort of cash equivalents that you have, prepaid expenses any that you have, or marketable securities that you can sell immediately, and any other sort of liquid assets that you have that are short-term assets. Those are included into your current assets. They are added together, and then there are current liabilities. Current liabilities, a major figure that you have is a trade payables, then unpaid expenses that you have to pay, and any sort of short-term liabilities that you have are under current liabilities. So all these figures added together under current assets and current liabilities respectively, then we have a current assets divided by current liabilities. So let's suppose your current assets are 10,000 and current liabilities are 5,000, then you will have a ratio of 10,000 divided by 5,000, which equals to 2:1, which is to be an ideal current ratio. And then a next advanced version of this is quick ratio, where under quick ratio what we do is we take only quick assets, not your current assets, and divide it by current liabilities. So you get another proportion where you just compare your quick assets. Now quick assets are your current assets except inventory. Why this? Because inventory is a major part of your current assets, but you also know that it takes time to convert your inventory into cash, or rather receivables, because you have to make sales and sometimes it takes a lot of time. So what we are trying to do is we are reducing the part of inventory, and we are just calculating current assets without inventory and then compare it with current liabilities. Because if we have to pay immediately without selling any inventory, because it may take some time, so what we are doing is quick assets divided by current liabilities. So in previous example we had current assets of 10,000, and now what we have is let's suppose inventory is rupees 5,000, out of which, so your current assets would be now only 5,000, because 10,000 minus 5,000 would be your quick assets, and your current liabilities already were 5,000. So now you will have a ratio of 5,000 divided by 5,000, which equals to 1:1. So now you get a better idea of current assets were 2:1, but your quick ratio is 1:1. So it gives a better idea of how liquid you are, how how immediate you can pay your current debts, that is short-term debts, current liabilities. So this is a great idea. Then we have solvency ratio. What is solvency now? Solvency is basically what happens if your long-term creditors, or rather long-term liabilities, non-current liabilities, you have to pay immediately. So we are just trying to say how solvent we are, how capable we are to pay our long-term debts if we have to pay today itself. So this is like we are just having an estimation, and it gives you a better position in, especially in stock market, if you are a listed company, because whenever someone looks at your balance sheet, they are just trying to do these analysis. So first one, we have debt to equity ratio. Debt to equity ratio is nothing but your total debts divided by your equity. Equity is your shareholders funds, where you have share capital and reserves and surplus. And under debt, you don't include your current liabilities, but you are short-term debt plus long-term. This is not like trade payables are not included here, but your debts, debt, that is, you have a loan. Let's suppose you have a loan for 5 years. It should be long-term loan, and there is another loan of 1 year, which would be, short-term loans. So all these loans are added together, and then any sort of fixed payments that you have are added together, which is to be divided by your equity capital. So let's suppose your debts are 1 lakh and your equity is only, your shareholders funds is only 50,000. So your debt to equity ratio becomes 1 lakh divided by 50,000, which becomes 2:1. So here you have that half of your debts are secured by shareholders funds, which gives a good impression. Okay, then we have total assets to debt ratio. Here your assets are compared with your debt. In the previous ratio, what we were doing is comparing owners funds with your debt, and here we are comparing your assets with your debt, how much debt is backed up by your assets. So here simply we have debt is simple, short term plus long term debts, and assets are also very simple, non-current plus current assets. Here we are including all the assets that you have, current, non-current, fixed, tangible, intangible, everything is added together, and then your debt is divided by total assets. So in the previous example we had your debt to be 1 lakh, and let's suppose your assets are 1,50,000. Okay, simple example. So your total assets to debt ratio would be total debt, that is 1 lakh divided by 1,50,000. So it would be 2/3, which gives a good impression, right? The next ratio that we have is proprietary ratio. Proprietary ratio is again quite simple. Here we are comparing your equity with your total assets, and not even total assets but your only total tangible assets, because when it comes to owners, the goodwill amount that you have is also belongs to owners, but we are not including the goodwill because it could be any imaginary figure, so we are not including goodwill here. So shareholders equity is very simple, share capital plus reserves and surplus that you have, that is accumulated profit. Then shareholders equity is divided by total tangible assets. So here what we are doing is in reducing the intangible assets from your total assets. So we had shareholders equity to be 50,000 in previous example, and total assets to be 1,50,000. Let's suppose your intangible assets are 50,000, so your non-tangible assets, your tangible assets would be 1,50,000 minus 50, so your tangible assets are 1 lakh and your shareholders equity is 50,000. So the ratio would be 50,000 divided by 1 lakh, so 1:2, which is again a good ratio. Okay, sorry. The next ratio that we have is interest coverage ratio. Here we are just trying to get an idea how many times our interest part is covered. So here we are not taking net profit because we are comparing interest with it, so we are adding the interest back to the profit, and also taxes, because interest is covered under taxes. You can reduce, interest is allowed as a deduction under income tax, so we are also adding back the taxes and interest, and we are getting the profit before interest and tax. That is why it is written as EBIT. EBIT stands for earning before interest and tax. So interest coverage ratio is very simple, EBIT divided by interest expenses. So let's suppose your net profit in the current example that we had was, net profit was 1,000. So your EBIT, let's suppose interest expenses are 1,000 and your net profit is 500. So what we are doing, 1,000 plus interest expenditure of let's suppose interest expenses is 500 and net profit taxes are also 500. So let's add these two together and your EBIT becomes 1,000 plus 500 is equal to 2,000. So EBIT 2,000 divided by interest expenses of 500, what becomes is equals to 4. So your interest coverage ratio is equals to 4. So your EBIT, that is your profit, is 4 times the interest expenditure that you have, so which is again a good signal. And let's move ahead. We have activity ratios here. So there are 3 types of ratios that we are gonna discuss. We have inventory turnover ratio, trade receivables ratio, and trade payables turnover ratio. So inventory, all these are very simple. Let's talk about inventory turnover first. Inventory turnover ratio is nothing but a comparison of your inventory with your sales. So we are not including the sales here because sales is like, profit is also there, but inventory is valued at cost. So we are taking the cost of goods sold instead of taking your sales figure. So cost of goods sold is divided by average inventory, and you get a turnover ratio of how many times your sales is as compared to your inventory. So we are not taking a opening or closing inventory but an average inventory, so that you have an idea of what inventory you had during the year. So average inventory is nothing but opening plus closing inventory divided by 2. You will get an average. And cost of goods sold is very simple, as opening stock plus purchases plus any sort of direct expenses and reduced by closing stock, you will have a cost of goods sold. That is why we are not comparing it with sales. So let's suppose your cost of goods sold is 8,000 and your average inventory is 2,000. So you will have an inventory turnover ratio of 8,000 divided by 2 is equal to 4, which is a very strong ratio. Okay, the next one that we have is trade receivables turnover ratio. Here we are again comparing your trade receivables with your sales, and in the previous one we were comparing inventory with your sales, not the actual sales but cost of goods sold. Here we are comparing your debtors with your sales, and debtors are associated with credit sales only, so we are comparing it with credit sales. In the previous one when we are comparing inventory, as inventory is related with cost, so we were comparing it with the cost of goods sold, and here debtors are included with credit sales, are associated with credit sales, so we are comparing it with net credit sales, after adjusting the returns that we had. So net credit sales are divided by average trade receivables, and as similar to the previous ratio, we are taking an average of trade receivables, which is very simple, opening plus closing divided by 2. And yeah, if we are going to give a formula to our net credit sales, which is total sales minus cash sales minus sales returns, which becomes your net credit sales. So let's suppose your net credit sales were just rupees 6,000 and your average debtors are 2,000. So the ratio would be 6,000 divided by 2,000 is equal to 3. So which is again a good, that is your credit sales are 3 times your debtors, which is like good, because as it says, your 1/3 of your sales are into debtors. And then again we have average trade payables turnover ratio, where we are comparing your average payables, that is average creditors, with your purchases. But creditors are associated with purchases, so we are comparing with purchases, and creditors are for credit purchases, as similar debtors were for credit sales. Creditors are associated with credit purchases, so we are comparing it with credit purchases only. So net credit purchases are very simple, total purchases minus cash purchases less any sort of purchase returns that we did. Okay, and average trade payables are again very simple, opening plus closing creditors or payables divided by 2. So let's suppose your net credit purchases are 4,000 and your average trade payables are 500. So if we are going to calculate 4,000 divided by 500, it would be 8. So a figure of 8, that is your purchases are 8 times your debtors, creditors. It's a good ratio. Okay, that's all for the ratio analysis that we have. And here we can also do your working capital analysis, where you can calculate your working capital by reducing current liabilities from your current assets, which would give you another idea of how liquid or how solvent you are. That's all. Thank you.